Ever wondered how companies across different countries prepare their financial statements in a consistent and reliable way? This is where approved accounting standards comes in. Approved accounting standards such as IFRS and IAS provide a common set of rules and principles that guide how financial information is recognized, measured, and presented. They help ensure that financial statements are transparent, comparable, and useful for decision making by investors, management, and other stakeholders. In today's presentation, I will explain how approved accounting standards are applied in real-world financial reporting. I will focus on 4 key standards: IFRS 8 on segmental reporting, IFRS 2 share-based payments, IAS 19 on employee benefits, and IAS 21 foreign currency transactions using practical examples from real companies. I will start with IFRS 8 on segment reporting. Large entities often produce a wide range of products and operate in different countries. Because of this, looking at only the total profit of a company may not give users a full picture of its performance. Segment reporting exists to help users better understand how an entity results are made up, assess its risk and returns, and make more informed judgments about the business as a whole. Different products and geographical areas are exposed to different profitability levels, growth opportunities, and risk, which is why IFRS 8 is important. The objective of IFRS 8 is to require entities to disclose information that allows users to evaluate the nature and financial effects of the business activities they engage in and the economic environments in which they operate. An operating segment is a component of an entity that earns revenue and incurs expenses, whose results are regularly reviewed by the chief operating decision maker and for which separate financial information is available. The Chief Operating Decision Maker, or which is called CODM, is the function responsible for allocating resources and assessing segment performance. An operating segment becomes reportable if it meets any of the 10% threshold based on revenue, profit or loss, or total assets. Additionally, at least 75% of the entity's external revenue must be included in reportable segments. For each reportable segment, companies must disclose revenue, profit or loss, and total assets together with a reconciliation to the entity's overall financial statements. Nestle Group provides a clear real-life example of IFRS 8 segment reporting. In its 2023 annual report, Nestle reports operating segment based on product categories such as powdered and liquid beverages, pet care, nutrition, and health science. For example, in 2023, Nestle Pet Care segment generated approximately 18.9 billion in revenue, making it one of the group's fastest growing segments. Nestle also provides geographical information showing revenue generated from regions such as Europe, the Americas, and Asia, Oceania, and Africa. This segmental reporting allows investors to see which business lines and regions contribute most to Nestle performance and where future growth opportunities and risks exist. Next, I will explain share-based payments under IFRS 2. Share-based payment transactions occur when an entity receives goods or services in exchange for equity instruments or amount based on the value of its shares. IFRS 2 exists because even though no cash may be paid, these transactions still represent a cost of the company and must be recognized in the financial statements. Under IFRS 2, share-based payments are mainly classified into equity-settled and cash-settled transactions. In an equity-settled share-based payment, the entity receives goods or services in exchange for its own equity instrument such as shares or share option. The accounting entry for equity-settled transaction is to debit an expense or asset and credit equity. In contrast, a cash-settled share-based payment occurs when the entity pays cash based on the value of its shares, such as share appreciation rights. In this case, the entity recognizes an expense and a liability. Share-based payment arrangements are agreed at the grant date, which the date when the entity and the counterparty enter into the agreement. The vesting date is the date when all vesting conditions are satisfied and the employee becomes entitled to the share-based payment. The vesting period is the period over which these conditions must be met, and during this period the expense is recognized. Under IFRS 2, the expense relating to a share-based payment is recognized over the vesting period based on the profitability of meeting the vesting conditions. If there is no vesting period, the entire expense is recognized immediately. IFRS 2 recognizes two types of vesting conditions. Market-based conditions are linked to the market price of shares and are considered during valuation. Non-market-based conditions such as a service or performance conditions must be considered when estimating how many equity instruments will vest. Microsoft Corporation provides a real-life example of IFRS 2 share-based payments. According to Microsoft 2023 annual report, the company grants stock options and restricted stock units to employees as part of its compensation strategy. In the financial year ended 30th June 2023, Microsoft recognized approximately $9.6 billion in shares-based compensation expense. These equity-settled share-based payments are measured at the fair value on the grant date and recognized as an expense over the vesting period, which typically ranges from 3 to 5 years with a corresponding credit to equity. This treatment ensures that the cost of employee service is properly reflected in Microsoft profit or loss, even though no immediate cash outflow occurs. Next, I will explain IAS 19 employee benefits. IAS 19 prescribes how companies should account for all forms of employee benefits to reflect the cost of providing benefits and the obligation owed to employees. The objective of IAS 19 is to ensure that financial statements clearly show how employee benefits affects an entity's financial position and performance. IAS 19 applies to four main categories of employee benefits. Short-term benefits include wages, salaries, bonuses, and paid leave payable within 12 months. Post-employee benefits includes pensions and retirement plans. Other long-term benefits include long service leave and long-term disability benefits. Termination benefit arises when employee is terminated, such as redundancy payments. Short-term employee benefits are recognized as an expense as employees render their services with a liability recorded for any unpaid amounts at year end. Termination benefits are recognized when the entity is demonstrably committed to terminating employment or offering redundancy benefits. These amounts are recognized immediately as an expense and a liability. Post-employment benefits are classified as either defined contribution or defined benefit plans. Under a defined contribution plan, the employer pays fixed contribution and has no further obligation. The expense recognized equals to the contribution due. Under a defined benefit plan, the employer promises a specific benefits after retirement. This requires actuarial valuation and the employer bears the risk. Maybank provides a practical example of IAS 19 employee benefits. In its 2023 annual report, Maybank discloses contributions to employee defined contribution plans, including the Employee Provident Fund (EPF) in Malaysia. For the financial year ended 31st December 2023, Maybank recognizes approximately 1.4 billion in staff costs related to salary bonuses and retirement benefits. Contributions to the EPF are recognized as an expense in profit or loss when employees render service with no further obligation once the contribution is paid. This reflects IAS 19 requirement to recognize employee benefits costs as they are earned by employees. Next, I will explain IAS 21, which deals with the effects of changes in foreign currency exchange rates. IAS 21 applies to accounting for transactions and balances in foreign currencies, translating the results and financial position for foreign operations during consolidation and translating financial statement into a presentation currency. The purpose of IAS 21 is to ensure that foreign currency transactions and foreign operations are reported consistently and that exchange differences are properly recognized in the financial statements. A key concept under IAS 21 is the functional currency, which is the currency of the primary economic environment in which the entity operates. Foreign currency refers to any currency other than the entity's functional currency. Monetary items include cash, receivables, and payables that will be received or paid in a fixed number of currency units. Exchange differences arises when the same amount of foreign currency is translated using different exchange rates. IAS 21 requires management to determine the functional currency based on the primary economic environment in which the entity operates. Primary indicators include the currency that influences sales, prices, and operating costs. Secondary indicators include the currency in which financing is raised and operating cash flows are retained. When the functional currency is not obvious, management must apply judgment and explain the basis for its decision. Foreign currency transactions are initially recognized using the spot exchange rate at the date of the transaction. At each statement of financial position date, monetary items are translated using the closing rate. Any exchange differences arising from the settlement or retranslation of monetary items are recognized in profit or loss for the period, unless they relate to a net investment in a foreign operation. The famous Apple company provides a real-life example of IAS 21 foreign currency transactions. Apple's functional currency is the US dollar, but it purchases components from suppliers around the world, including Asia. For example, suppose Apple purchased components from a Japanese supplier on 1st of March 2023 for 100 million yen when the exchange rate was 130 yen for $1 USD. The purchase would initially be recognized at approximately $769,000 USD. If the payable was settled on 30th April 2023, when the exchange rate changed to 140 yen, which is for $1 USD, Apple would recognize an exchange gain or loss in profit or loss for the difference arising due to the rate movement. This treatment ensures the exchange rate fluctuations are transparently reflected in financial performances as required by IAS 21. In conclusion, approved accounting standards such as IFRS 8, IFRS 2, IAS 19, and IAS 21 plays a crucial role in ensuring transparency, consistency, and comparability in financial reporting. By applying these standards, companies provide users with reliable information about performance, employee costs, foreign currency risk, and segment results. This helps investors, regulators, and other stakeholders make informed decisions and enhance confidence in financial statements across global markets. Thank you for watching this video. I hope at the end of this video you learned something about accounting standards.